Hey guys, what's going on? My name is Tom Spark. Welcome back to another video. As you know, I made recession-aware, and my main theory for right now is that a recession is coming in 3 to 9 months. So I've been making a lot of finance and economic videos with my various thoughts, opinions, and analysis, stuff like that. But when push comes to shove, it's time to own up and say this. Have I been right? Have I been wrong? I've been making content like this for 1 month, and I want to do monthly check-ins to see how my thesis and base case is doing compared to just the general economy and other investment strategies. So let's go ahead and check in. I have a portfolio tracker on my website anyone could use and check out what's going on. Check out recession-aware. It's only $29 a month, or you could use a free version. It's really up to you. So guys, as you can see here on my base case for my website is you probably should be, or at least I'm doing this. I'm following the model to see how we could go. It's around 50 to 70% cash. That's my recommendation based on the risk levels. The risk levels are pretty high, around 55. So that is what I'm doing. I'm mostly holding cash and some safe treasury bonds. Stuff like IEF is a good example. ZROS might be something to look into a little later on down the line if we get a little bit closer to a recession to see some huge gains. However, let's see how things stack up. If you're holding 50 to 70% cash, as my model would suggest right now, you would have 0% gains. So if you compare the model's cash position to the Sp 500, well, you just saved 0.21%. So the model position of holding cash is doing better than the Sp 500, so we are winning there. If you've been holding something like IEF, which is probably one of my favorite treasury bonds right now, it's very safe, but with good upside. If we do have a recession, you're going to be down 0.35%. So it's not too much worse than the S&P, and you might be a little early for that. But honestly, the performance for the safety it guarantees is not too bad, because S&P 500 can go down maybe 20, 30, maybe 40, 50% in a recession, whereas IEF is going to be doing much better. It's going to be going up during a recession because these things like low interest rates and other kind of recessionary things that happen. So for just a little bit more bleeding right now than the kind of core stock market, that's pretty good in my opinion. But if we take a look at some of the other individual stocks, for example, let's see how we did there. Well, if you're holding what my model suggested to be around 50 to 70% cash with some treasury bonds is kind of what we're recommending, or at least the model is recommending. Let's say you compare that to something like Oracle. Well, Oracle's down almost 25%. Yikes. Microsoft down almost 7%, 6.46. NVIDIA is almost down 10%. Tesla is down around 4% since this website was created. So all this stuff is aligned directly to when the website was created. AMD is down 17%, Amazon down 9%, and Apple is up 1%, with Google really the only one doing well here in this narrow selection of stocks, around up 10%. So best case scenario, you could have made 10%. But a lot of this stuff is pretty painful. I think the model's done pretty well. I think I've done pretty well with this model. So if we have 0% decrease or gains, that's a lot better than minus 17 with AMD, Oracle, and a lot of these other ones. Additionally, even if you pick something like ZROS, which is a 25-year coupon treasury ETF, 6% down isn't too bad when you compare it to something like Oracle, AMD, and even something like NVIDIA. A lot of these stocks are bleeding, and a lot of people will think that, these interest rates cuts and stuff like that are going to save the economy. But if you just look at the performance in the last month, you are starting to see things slip, and that is my base case. I do think we're just slowly going to be slipping and slipping and slipping. We're seeing job reports come out being negative and stuff like that. So overall, guys, what do you think of how the model has done? Do you think it's done well? Obviously, if you picked Google, you would have beat the model, but no one knew just to put everything in Google. So also the model does recommend 50 to 70% cash right now, and you might have had that 30% in Google, let's say that, or 30% in one of these would have went down, but it's kind of up to you. There could have been, like I said, this is only this amount of stocks. You could put it into some other ones, maybe McDonald's or some of these other ones. But in general, I think cash right now is a good idea. It's performed a lot better than most of these stocks here. So food for thought. Check out recession-aware if you like this analysis, and I'll see you again very soon.